Have you ever wondered how a world this rich can also be a world this deeply in debt? Because right now, as you watch this video, the global debt clock is racing toward a number so large it barely feels real. More than $250 trillion. The IMF's estimate of total global debt in 2023, a burden equal to roughly 237% of the entire world's GDP. If that number doesn't shock you, then look closer. The United States, supposedly the strongest economy on earth, is carrying a national debt in the high 30 trillion range, approaching levels never seen in American history. Japan owes even more when you compare debt to the size of its economy, a staggering 200% plus debt-to-GDP ratio, the highest of any major developed nation. China, the rising giant, holds massive layers of government, corporate, and shadow debt that analysts struggle even to measure. Europe, Germany, the disciplined economy, is quietly climbing towards 60-65% debt to GDP, faster than anyone predicted. So here's the question no one ever asks. If every major nation on earth is in debt, WHO is the world actually borrowing from? Where is all this money coming from? Who is sitting on the other side of these numbers? And why does the debt keep rising? No matter who is in power, no matter what policies change, no matter how much people sacrifice. Because once you uncover the answer, once you understand how government bonds, global lenders, and shadow institutions truly work, you'll realize something unsettling. Debt is not the failure of the system. Debt is the system. And the world you live in, your taxes, your currency, your stability, is built on a financial architecture most people will never see. Tonight, we're going inside that architecture. Before we dive into the machinery behind global debt, before we uncover the lenders no one sees and the systems no one questions, you need to understand one simple truth. Debt is not an accident. Debt is the backbone of modern civilization. Governments borrow not because they are reckless, but because the world they built cannot function without borrowing. Every bridge, every hospital, every war, every bailout, every stimulus check, every rescue package, they all come from the same place. Money that didn't exist yesterday but must be paid back tomorrow. Global debt has climbed to more than 250 trillion, a figure confirmed by the IMF, a mountain equal to 237% of the entire world's economic output. And yet, the system has not collapsed. Instead, the world keeps borrowing. The United States continues running deficits even as its national debt hovers around the $37.8 trillion level, a number so large it now exceeds the size of the U.S. economy. Japan keeps refinancing obligations despite owing more than 2 times its own GDP, a ratio experts once thought impossible for a modern nation to survive. China's debt, public, private, corporate, and hidden, has expanded into a multi-layered labyrinth that even global institutions struggle to fully map. And Germany, considered the most disciplined economy in Europe, is now moving past 60% debt to GDP as defense spending and energy shocks reshape the European landscape. If all of this feels unsustainable, that's because it is. But here's the paradox. The global economy needs debt to function. It needs governments borrowing. It needs markets funding those debts. It needs banks, institutions, and shadow networks constantly feeding money into the system just to keep it alive. Without debt, countries would collapse, markets would freeze, governments would run out of oxygen. This is why no one stops borrowing. This is why the debt keeps rising. This is why every nation, rich or poor, is trapped inside the same financial cycle. Tonight, we pull apart that cycle. Not to scare you, not to sensationalize, but to reveal the quiet architecture behind global power, the lenders, the markets, the institutions that hold nations by the purse strings. When the world borrows, someone profits. And it's time to understand who that someone really is. To understand how we reached a point where the world owes more than 250 trillion, you have to rewind history to a moment most people never think about. The moment when governments discovered that borrowing wasn't a weakness, it was a superpower. Because debt did not begin as a crisis. Debt began as a solution. Look at the early decades of the 20th century. Nations were rebuilding from wars, industry was accelerating, populations were exploding, and technology was reshaping everything from communication to transportation to global trade. Countries needed money, far more money than they could collect through taxes or production alone. And in that need, they discovered something transformative. Borrowing could create prosperity faster than saving. Borrowing could build roads, fund militaries, modernize cities, and jumpstart entire economies. Debt became the fuel of progress, and soon, one by one, nations learned to lean on it. The United States started issuing large-scale treasury bonds. Today, those bonds back a national debt that's now in the 37-38 trillion range, according to U.S. Treasury data, larger than the entire U.S. economy itself. Japan pushed the model even further. Its government spent heavily to stimulate growth after the 1990s crash, and today it holds a debt-to-GDP ratio above 230%, the highest of any major economy on Earth. China expanded through aggressive investment, infrastructure, housing, state companies, financed by layers of government, local, and corporate debt so vast that even institutions like the World Bank describe them as difficult to fully measure. Europe followed the same pattern. Even Germany, the continent's financially disciplined anchor, sits around 60–65% debt to GDP and is climbing toward levels that would have been unthinkable a decade ago. Debt became normal, predictable, expected, but that normalcy came with a hidden switch. Because once a government borrows, it cannot easily stop. Debt begets more debt. Interest must be paid. Bonds must be refinanced. Budgets must be stretched. And the only way to keep the machine running is to keep feeding it. That's why global debt today sits above 250 trillion, roughly 237% of the world's total GDP, according to the IMF's Global Debt Monitor. It's not a glitch. It's not a mistake. It's the design. The world grows through borrowing. Countries expand through borrowing. Governments survive through borrowing. And every time they borrow, someone else gains leverage. Someone else buys their bonds. Someone else profits from their interest. Someone else becomes the silent creditor of entire nations. Debt became the world's oxygen. And the people who control that oxygen suddenly held more power than any election, any military, or any political speech could ever match. But who are those people? Who are the lenders holding the strings behind the curtain? And how do they profit when entire nations sink deeper into obligations they can never truly escape? To answer that, we have to go deeper, into the next layer of the global financial machine. Every major nation on Earth is drowning in debt. Then the next question is unavoidable. Who is lending the money? Who has enough resources to bankroll entire governments? Because it's not just one group. It's not one country. It's not one billionaire in a private room. It's a network, a layered structure of institutions and markets that quietly hold the world's most powerful IOUs. And the deeper you look, the more you realize something unsettling. The lenders are not visible, but their power is. Governments don't borrow from a single vault. They issue bonds, promises to repay with interest, and those bonds spread across the global financial system like seeds carried by the wind. The first layer of lenders is the massive players. Pension funds, insurance companies, sovereign wealth funds, institutions that control trillions in assets and consider government bonds the safest investment on Earth. Japan's pension funds, Norway's sovereign wealth fund, U.S. insurance giants, they buy government debt by the tens of billions at a time. They are the quiet giants behind national budgets. But behind them stands another force, one even more influential: central banks, the U.S. Federal Reserve, the European Central Bank, the Bank of Japan, the People's Bank of China. These institutions create money, set interest rates, and often directly purchase government debt to stabilize markets. Japan is the most extreme example. Its central bank has purchased such enormous volumes of government bonds that analysts say it now holds almost half of Japan's entire debt market. Half. That alone shows how deeply nations depend on their own money creators to survive. But then we reach the third layer, the one the public almost never hears about: the shadow banking system. Not shadow because it's illegal, but because it operates outside the traditional regulatory spotlight. Offshore investment vehicles, private credit groups, hedge funds, money market funds, complex lending networks that move trillions without ever appearing on a standard banking balance sheet. The OECD estimates that shadow banking is now larger than the traditional banking system in many major economies. And when a government needs money fast, when crisis hits, these shadow lenders step in at interest rates that ride on fear, not fairness. Finally, standing above all these layers like the atmosphere around the planet is the global bond market. A force so enormous, so liquid, so automated that nations can be rewarded or punished in a matter of minutes. Traders, funds, algorithms, they don't care about speeches, elections, or ideology. They care about one number: risk. If investors think a country is safe, money pours in easily, interest rates stay low, debt feels manageable. But if confidence drops, even slightly, the bond market punishes instantly. Interest rates spike, budgets collapse, currencies fall, governments panic. This machine, this ecosystem of pension funds, central banks, shadow financiers, and global markets is the real creditor of the world. Not one person, not one country, not one villain. A system. A system so large that even the United States, with nearly 38 trillion in national debt, depends on the trust of lenders to function. A system where Japan's record-breaking 230% debt to GDP is sustainable only because bond buyers believe the Bank of Japan will never let the system collapse. A system where China's complex layers of state and corporate debt create vulnerabilities that the world watches with silent caution. A system where Germany, even at 60-65% debt to GDP, depends on European central bank confidence to maintain stability. And here's the twist: none of these lenders act alone. They move together, sometimes intentionally, sometimes through the momentum of global markets. When one shifts, the entire world feels it. Debt is not just money, debt is influence, and the lenders, the ones who buy, sell, shift, and shape these bonds, quietly influence everything from taxation to government spending to national policy. But influence is only the beginning, because what happens when a country owes more than it can ever repay? What happens when the interest alone becomes unbearable? Who steps in then? Who controls the crisis? And who profits when nations fall? To answer that, we must go even deeper into the mechanics of the trap itself. Debt begins as a tool, but over time, it becomes a cage. Countries rarely fall into crisis because of one bad decision. They fall because debt follows a pattern, a predictable, repeating cycle that every nation eventually gets caught in. It starts with something innocent. A government issues bonds to fund growth, schools, roads, hospitals, technology, infrastructure that boosts the economy and wins public trust. The lenders are happy, the markets are calm, interest rates stay low, borrowing feels safe. But debt has a quiet habit of multiplying. One round of bonds becomes another, then refinancing, then rolling over. The new borrowing to pay old borrowing, a cycle the IMF says now drives most of the world's 250 trillion debt load, more than 237% of global GDP. And here is the moment where everything changes. Countries stop borrowing to grow and start borrowing to survive. The United States refinances staggering sums just to keep its 38 trillion debt afloat. Japan rolls over bonds constantly to sustain debt that's more than 230% of its entire economy. China restructures hidden layers of local and corporate debt because default would shake global markets. Europe adjusts budgets and taxes to keep debt under control. Even Germany sits near 60-65% debt to GDP and rising faster than expected. The trap tightens because once a nation enters this stage, the lenders, the markets, the institutions begin to watch it more closely. And when the lenders watch, their trust becomes everything. If investors sense weakness, they demand higher interest. If interest rises, the debt becomes heavier. If the debt becomes heavier, more borrowing is needed. And more borrowing leads to even less confidence, a downward spiral. We saw this spiral in countries like Greece during the Eurozone crisis, where rising interest rates turned one financial injury into a national catastrophe. We saw it in Argentina, in Lebanon, in Sri Lanka, nations trapped so deeply in repayment that basic services collapsed. And what caused those collapses? Not just spending, not just politics, not even mismanagement alone. It was the bond market's loss of trust, because in the global debt system, trust is currency. Lose it, and your entire economy begins to sink. But here's the twist the world rarely acknowledges. Countries almost never escape their debt, not through growth, not through austerity, not through reform. They escape the fear of debt, not the debt itself. The US doesn't pay down its principal, it rolls it forward. Japan doesn't eliminate its debt, it sustains it through its central bank. China doesn't clear its obligations, it restructures and redistributes them. Even Germany, known for strict fiscal discipline, expands its debt when the system demands it. Debt doesn't go away, it transforms. And as it transforms, the lenders gain more leverage. They don't just earn interest, they influence policy. They shape national budgets. They decide which governments are safe and which are risky. They control the cost of borrowing, a power greater than taxation, greater than elections, greater than ideology. Debt becomes a quiet political force, one that never campaigns, never debates, never appears on ballot boxes, but decides the fate of nations. And this is only the beginning. Because once a country is trapped in the debt cycle, another question rises: what happens when the lenders start asking for something more than money? To answer that, we need to go deeper into how global debt turns into global influence. Once a nation falls deep enough into the cycle of borrowing, a subtle shift begins. A shift so quiet that most citizens never feel it happening, but their governments do. Because lenders don't always need to speak to be heard. They don't need to threaten to be obeyed. They don't need armies to shape policy. They only need one thing: a nation that cannot function without their money. And when that point arrives, the balance of power starts to tilt. At first, it's invisible, a slight change in the tone from credit agencies, a minor adjustment in interest rates, a quiet recommendation from an international institution. But each of these small signals carries the weight of billions. Investors begin watching a country more closely. Central banks react differently. Bond markets move cautiously. Suddenly, the government doesn't just borrow money, it starts borrowing trust. The United States faces this pressure too. With nearly $38 trillion in national debt, its treasury must constantly convince global investors that America remains the safest place for their trillions. Japan's debt, more than 230% of its GDP, looks impossible on paper. Yet the country survives because the Bank of Japan keeps buying enormous quantities of bonds to prevent panic. China manages sprawling layers of public and corporate debt, and any hint of instability sends global analysts on high alert. Germany, even near 60–65% debt to GDP, knows that any disruption in European trust will immediately raise its borrowing costs. Every nation, even the richest, is forced to listen when the lenders shift their tone. This is where debt becomes influence, not loud, not dramatic, not through ultimatums, but through expectations. Then it must demonstrate responsibility. How? By adjusting budgets, cutting spending, raising taxes, or restructuring programs. Not because the lenders said so explicitly, but because the government knows what will happen if it doesn't. Lose investor confidence and borrowing costs rise. Lose investor confidence and currency values fall. Lose investor confidence and economic plans collapse. The bond market doesn't need to punish you on purpose. It punishes you by instinct, and this instinct reshapes nations. Suddenly, political promises become secondary to what investors want. National priorities bend to fit the expectations of global creditors. Entire budgets are written with bond markets hovering in the background. A government might say it serves its people first, but it survives only if the lenders approve. This is why debt isn't just an economic tool. It's a quiet form of governance. A country can elect leaders, change parties, rewrite laws, but it cannot escape the interest rate. The interest rate does not care who won the election. The interest rate does not care what ideology prevails. The interest rate does not care how patriotic a nation claims to be. If confidence falls, the rate rises. If the rate rises, the nation bends. And this dynamic reveals something uncomfortable. In the modern world, financial systems hold more consistent power than political systems. Governments serve terms. Markets operate forever. Leaders come and go. Creditors stay. The public debates ideology. Investors measure risk. And whether a nation likes it or not, its debt becomes a negotiation, one where the loudest voices are never heard on television, never seen in public, never voted into office. They whisper through yields, they signal through bond spreads, they intervene through liquidity. Their influence is silent, but absolute. And this influence does something else, something deeper, something more lasting. It shapes the future of nations before the nations themselves even realize it. Because once debt becomes the steering wheel, the country holding it is no longer driving alone. By the time a country becomes dependent on debt, its choices are no longer fully its own, not because someone takes control by force, but because the invisible logic of the financial system begins steering decisions from behind the curtain. This is the point where debt stops being a number and becomes a compass calibrated not to national priorities, but to the expectations of the lenders who keep the country afloat. Governments don't announce this shift. Citizens don't vote for it. But it happens slowly, quietly, methodically. A finance minister prepares the national budget. They look at interest rates. They look at the bond market. They look at investor sentiment. And before they write a single line, they already know what they're allowed to do. They know how much they can spend without alarming creditors. They know how much they must cut to keep interest rates down. They know which programs are too expensive, not because the people don't need them, but because investors don't like them. Debt becomes a filter, the unseen gatekeeper of national priorities. And here's the part no one ever tells the public. The bigger the debt, the narrower the choices. Take the United States. With over $38 trillion in national debt, the government spends hundreds of billions each year just paying interest on past borrowing. Money that could have built infrastructure or funded services, now redirected to satisfy creditors. Japan, with debt above 230% of GDP, must carefully coordinate every policy with the expectations of investors and the commitments of its central bank, or face catastrophic spikes in borrowing costs. China, due to its complex layers of public and private liabilities, must manage economic reforms cautiously to avoid triggering a loss of confidence in markets already watching it closely. Germany, near 60-65% debt to GDP, faces EU rules, bond markets, and internal budget pressures that shape how it spends, invests, and maintains its economic identity. And this influence doesn't just shape budgets, it shapes policy. When debt rises, governments are pushed, often silently, towards certain decisions. Cut spending, raise taxes, privatize assets, delay infrastructure, shrink social programs, increase retirement age, freeze public hiring, reduce subsidies, reform regulations, lower deficits at any cost, not because these choices are always right, but because they reduce risk for the lenders holding the nation's bonds. It's not political ideology, it's financial gravity. A government may want to invest in its people, but the bond market may want austerity. A government may want to reform healthcare, but investors may prioritize deficit control. A government may want to modernize its infrastructure, but credit agencies may punish the spending. And so, the nation bends, slowly, quietly, predictably. Debt becomes a silent editor rewriting the script of national destiny. This is the influence few recognize, because it doesn't come through force, but through consequences. If a leader makes the wrong move, borrowing costs jump. If costs jump, budgets shrink. If budgets shrink, voters suffer. So politicians learn to listen to the invisible voices of the financial system, not out of loyalty, but out of survival. And just when you think this dynamic couldn't go any deeper, it does, because influence is only the second stage. The third stage is when lenders don't just shape policies, they shape the future. By the time debt begins shaping a country's policies, a deeper transformation has already started. One far more permanent, far more structural, and far more difficult to reverse. It begins when lenders stop reacting to governments, and governments start reacting to lenders. Because a nation can argue about budgets, it can debate ideology, it can fight over policies, but it cannot escape the reality written on its balance sheet. And slowly, quietly, debt begins to do something remarkable. It starts determining the future, not in dramatic headlines, not in televised announcements, but in the silent architecture of national decisions, the choices that shape decades. A government wants to build new industries, it must consider how investors will respond. A government wants to fund innovation, it must calculate the impact on long-term yields. A government wants to strengthen its military, modernize infrastructure, or expand social services, then it must evaluate how much debt room it has left before the markets tighten the leash. Look at how the world behaves today. The United States, with nearly $38 trillion in debt, now spends more on interest payments than on many domestic programs, forcing policymakers to prioritize what keeps the markets calm over what keeps society moving forward. Japan, with its 230% debt-to-GDP burden, knows its future economic strategy cannot exist without the Bank of Japan supporting bond markets indefinitely. China understands that its economic model, built on infrastructure, investment, and credit, must evolve carefully or risk destabilizing hidden liabilities that global institutions warn are difficult to fully quantify. Germany, with its rising 60-65% debt levels, faces pressure to adjust energy investments, military budgets, and EU contributions to avoid unsettling European bond markets. The future of each of these countries is being shaped not only by goals and ambitions, but by constraints. Debt isn't just a number, it becomes a boundary, a limit, a silent fence around national imagination. And within those boundaries, lenders begin to shape what nations value. If markets favor stability, governments avoid risky innovation. If markets favor austerity, governments reduce investment. If markets favor privatization, governments sell assets. If markets favor deregulation, governments loosen rules. None of these decisions appear forced. They look like strategy. They look like policy. They look like governance. But beneath the surface, they are survival mechanisms, responses to a financial ecosystem that rewards obedience and punishes unpredictability. And the deeper a nation slips into debt, the more its future narrows. Which industries grow, which industries die, which allies are chosen, which alliances fade, which currencies remain strong, which currencies fall, which technologies get funded, which innovations are delayed, which generations are empowered. Which generations inherit the burden. Debt begins shaping all of it, not because lenders want to rule nations, but because the structure of debt itself pulls countries down the same pathways. Borrowing leads to dependency. Dependency leads to influence. Influence leads to direction. Direction leads to fate. And once fate is written, nations rarely escape the ink. Because the modern world is not built on physical borders or military strength or political ideology. It is built on flows. Flows of money, flows of credit, flows of trust. And whoever controls those flows controls the future. But there's still one piece missing. Debt shapes nations. Debt reshapes futures. But what happens when the entire global system is at risk of collapsing under its own weight? Who steps in then? Who stabilizes the world? And in that moment, who becomes more powerful than any nation on earth? To answer that, we must go to the last layer of the system, the one most people never see. When a nation starts sinking under its debt, when investors pull back, when interest rates spike, when currencies shake and governments lose control of their own budgets, there is a moment where the world holds its breath. Because if one country collapses, the shock can spread like a virus, through markets, through banks, through trade routes, through entire regions. We saw it in Greece, in Argentina, in Lebanon, in Sri Lanka, in Turkey, in multiple African nations crushed by external debt. Debt collapses don't stay local, they travel. And when the collapse begins, the global financial system does something extraordinary. It summons the lenders of last resort, institutions that don't operate like normal creditors. Institutions that don't just lend money. They enforce restructuring, they impose conditions, they rewrite the future of the countries they rescue, and the most powerful among them is the institution everyone has heard of, but few truly understand, the International Monetary Fund, the IMF. When a nation is in trouble, the IMF steps in with billions in emergency funds. But these funds never come without rules. They demand cuts, they demand reforms, they demand tax increases, they demand spending freezes, they demand fiscal discipline. Their goal is not punishment, it's stabilization. But stabilization has a price. Because IMF conditions reshape entire governments, entire economies, entire generations. And when the IMF speaks, nations listen. Not because they want to, but because they have no choice. Behind the IMF stands another titan, the World Bank. Where the IMF stabilizes nations in crisis, the World Bank restructures them afterward. Loans for development, loans for rebuilding, loans for long-term transition, but, again, with conditions. A nation cannot take that money without agreeing to reforms that shape everything from education to infrastructure to industry to governance. This is influence on a global scale, not by force, but by necessity. Then there's another group, one far less known but equally powerful, the multilateral development banks and regional stabilizers, the Asian Development Bank, the African Development Bank, the European Stability Mechanism, the Inter-American Development Bank. These institutions step in when regions collapse, holding entire continents together through credit and conditions. And finally, the quietest but most powerful financial stabilizer of all, central banks. When the U.S. Federal Reserve adjusts interest rates, the entire world shakes. Currencies rise and fall. Debt becomes cheaper or more expensive overnight. When the European Central Bank changes liquidity, European bond markets reorganize instantly. When the Bank of Japan maintains ultra-low rates to manage its 230% debt load, global investors recalibrate. Central banks don't save countries one at a time. They stabilize the entire global system in real time. They are the heartbeat of the financial world, setting the rhythm that every nation must follow. And when a crisis hits, their beat grows louder. Nations collapse. Currencies crumble. Markets panic. But these institutions, the IMF, the World Bank, the central banks, the regional lenders, step in as the architects of survival. They don't need military forces. They don't need elections. They don't need public approval. Their power is more elemental. They control liquidity, the oxygen of modern economies. With a loan, they can save a nation. With a condition, they can reshape it. With a program, they can define its future. This is the final truth of global debt. The world's most powerful countries are not the ones with the strongest armies or the loudest politicians. They are the ones who control the money when everyone else runs out of it. And once a nation reaches this layer, once it relies on these institutions for stability, its destiny is no longer determined by its past, but by the requirements of the system that saved it. But even this isn't the end. Because if global debt keeps rising, if nations keep borrowing without end, if the system stretches further, a final question emerges. What happens when even the lenders of last resort can't hold the weight anymore? That answer, the one no government wants to face, awaits in the final chapter. The global debt system has survived world wars, financial crashes, pandemics, political upheavals, and technological revolutions. But now, for the first time in modern history, it is facing a challenge from every direction at the same time. Debt keeps rising, interest keeps growing, budgets keep shrinking, markets keep tightening, populations keep aging, and economies keep slowing. The math is becoming harder to ignore. Global debt passed 250 trillion, climbing to more than 237% of world GDP, a figure the IMF warns is dangerously high. The United States must refinance trillions yearly just to keep its 38 trillion debt from collapsing the system. Japan must rely on its central bank to support a 230% debt-to-GDP ratio that no private market would ever sustain alone. China must navigate a labyrinth of public, private, and shadow debt that global institutions struggle to measure accurately. A debt so vast it could ripple across continents if it faltered. Even Germany, Europe's fiscal anchor, is now edging past 66.5% debt, a level that breaks its long-standing principles and signals a new era of uncertainty. Put all of this together, and the world finds itself standing on a fragile balance beam, supported by institutions that were never designed to carry this much weight. And here's the truth that rarely appears on news broadcasts. The global financial system can survive almost anything except losing trust. If investors lose faith in U.S. bonds, the world loses its primary safe asset. If Japan's central bank stops supporting its bond market, the yen could spin into chaos. If China's hidden liabilities surface all at once, global markets would freeze. If Europe fractures economically, its unified debt structure could shatter. These aren't theories. They are warnings, subtle but constant, from the IMF, the World Bank, and analysts around the world who watch the numbers climb higher every year. Debt is no longer a tool. It is a global dependency, a shared vulnerability, a system we cannot function without and cannot escape from. Every nation leans on it. Every lender depends on it. Every market responds to it. Every institution supports it. Every crisis requires more of it. And that dependence raises the final question, the most important question of all. What happens when the system reaches its limit? Will the world innovate its way out? Will new financial models rise? Will nations coordinate? Will lenders rewrite the rules? Will central banks expand even further? Will debt become infinite, a number that grows forever without ever collapsing? Or will the world finally confront a truth that has been hiding in plain sight, that the system we built was never meant to carry this much weight? And yet, it keeps going, not because it's stable, not because it's safe, but because stopping would be far more dangerous than continuing. This is the paradox of modern civilization. We cannot live with this much debt, and we cannot live without it. Which leads to one final haunting realization. If the world is built on debt, then the world is only as strong as the people who control it. And in the end, those people are not the ones we elect. So after all the numbers, all the charts, all the warnings, what does it really mean? A world with more than 250 trillion in debt. A world where the United States carries 38 trillion, Japan over 230% of GDP, China's liabilities deep and opaque, and Europe drifting past its old limits. A world where borrowing never stops, where refinancing never ends, where interest becomes a second tax on every generation. What does a world like that become? It becomes this, a world where debt is not a crisis, but a currency. A world where borrowing is not a choice, but a requirement. A world where governments don't control money, money controls governments. Debt has become the bloodstream of modern civilization, circulating through nations, feeding markets, sustaining economies, and keeping the global machine alive. But every bloodstream has a heart, and the heart of this one is not a country, not a leader, not a politician, not a billionaire. It is a system, an invisible, unstoppable, self-sustaining system that grows every year as debt rises higher and higher and higher. A system where trust is currency and collapse is forbidden, where central banks stabilize nations and lenders of last resort reshape them, where institutions most people never think about hold more influence than entire governments. And this system survives for one reason, because the alternative is unthinkable. If the world stopped borrowing, the world would stop moving. Everything would freeze. Markets, trade, development, government, security. Everything we built depends on numbers we can never repay. Debt is no longer about money. Debt is about momentum, a momentum that must continue because stopping it would break the spine of the global economy. So does the system collapse? Not today, not tomorrow, maybe not for a long time. Because every time the world reaches the edge, the system adapts, it evolves, it finds a new way forward. Debt becomes restructured, debt becomes refinanced, debt becomes normalized, debt becomes infinite. And that is the secret most people never learn. The world doesn't plan to pay its debt. The world plans to manage it. Endlessly, silently, strategically. The numbers rise, the future narrows, the lenders grow stronger, and the machine keeps turning. So remember this, the next time you hear a government promise growth, or a politician promise reform, or a leader promise change, promises don't run the world, debt does. And until the day the world rewrites its financial DNA, the most powerful force shaping our lives won't be the people we elect, but the debt we never see.